Welcome to this lesson. In this lesson, we are going to discuss the double entry principle. So what is the double entry principle? The double entry principle explains the effect of a transaction on the elements of financial statements. You will recall from our earlier discussions that we said the elements of financial statements include your income, expenses, assets, liabilities, and equity. Therefore, every transaction will either affect one or two of those elements, and the double entry principle tries to explain the effect of that transaction. The double entry principle says every transaction is recorded twice, once as a debit and once as a credit, and that will ensure that your accounting equation remains balanced at all times. You therefore cannot have a transaction that will have one leg, either a debit or a credit. Every transaction must have a debit and a credit. For every debit, there must be a credit, and for every credit, there must be a debit. The key rule of the double entry principle says the total debits must be equal to the total credits. We're now going to look at the application of this principle. In applying the double entry principle, we group the elements of financial statements according to the direction that they follow in every transaction. Assets and expenses follow the same direction. They increase on the debit side and decrease on the credit side. Equity, liabilities, and income also follow the same direction. They decrease on the debit side and increase on the credit side. We are now going to look at a couple of transactions so that we can apply this theory and see if we understand it. The first transaction that we have is a capital contribution of 500,000 into the business. The affected accounts in this transaction is the bank and capital. The related element, the bank is an asset, capital is equity. The effect of this transaction on the elements is that assets and equity are increasing. Then in applying the double entry, we are going to debit the bank because the bank is an asset and assets increase on the debit side. We are going to credit capital. Capital is equity and equity increases on the credit side. The second transaction we are going to look at is the receipt of a loan of 500,000. The accounts that are affected in this transaction is the bank and the loan. The related elements, the bank is an asset, the loan is a liability. The effect of this transaction on the elements is that both the assets and liabilities are increasing. Then in applying the double entry, we are going to debit the bank because the bank is an asset and assets increase on the debit side. We are going to credit the loan because the loan is a liability and liabilities increase on the credit side. The third transaction we are going to look at is a credit sale of goods for 25,000 and the cost price of those goods was 20,000. This transaction has got two legs. We are first going to look at the first leg. The affected accounts on the first leg is the debtors control and sales. The related elements, debtors control is an asset, sales are an income. The effect of this transaction on the elements of financial statements is that both assets and income are increasing. Then in applying the principle, we are going to debit debtors control because debtors control is an asset and assets increase on the debit side, and we are going to credit sales. Sales are an income and income increase on the credit side. The second leg of the transaction is that the affected accounts is the trading stock and cost of sales. The related elements, trading stock is an asset, cost of sales is an expense. The effect of this transaction on the elements of financial statements is that assets are decreasing, which is the decrease in your trading stock, and expenses are increasing, which is the increase in your cost of sales. In applying the double entry, we're going to debit cost of sales because cost of sales is an expense and expenses increase on the debit side, and we are going to credit trading stock. Trading stock is an asset, and assets decrease on the credit side. The next transaction we are going to look at is the purchase of a delivery vehicle on credit for 175,000. The accounts that are affected is the creditors control and vehicles. The related elements, creditors control is a liability and the vehicle is an asset. The effect of this transaction on the elements of financial statements is that both the liabilities and assets are increasing. Then in applying the double entry, we are going to debit vehicles because a vehicle is an asset and assets increase on the debit side. We are going to credit the creditors control. Creditors control is a liability and liabilities increase on the credit side. And this is how we would write the journal. We are going to debit the bank for the first transaction, credit capital. Debit the bank for the second transaction and credit the loan. The third transaction, debit debtors control, credit sales. Debit cost of sales, credit trading stock. And the last transaction, going to debit vehicles and credit creditors control. And that brings us to the end of our lesson on the accounting principle.